very pleased to welcome back to the show right now, though, Dr. Michael Berry. He is a co-editor of the Disruptive Discoveries Journal. Dr. Berry, thank you so much for taking the time.
It's great to be back and speak with you, Michael.
I feel like I've got fantastic timing with you and just a little bit of your background, besides, of course, writing the successful Disruptive Discovery Journal. But also, you've made numerous presentations to the Federal Reserve, presentations to financial analysts, etc. And what a perfect week to get you here when Janet Yellen again caused a stir, midweek when she says again that rate increase is still on the agenda, on the docket, and probably within the next couple of months. First of all, what did you make of that, and what are investors supposed to make of that? Because that seems like Groundhog Day.
Well, I think you're right. It is like Groundhog Day. You wake up and you hear the Fed talking about raising rates, and then they postpone it. I think what she said was, if things keep improving, then probably Fed funds rate is on tap. So my guess would be maybe July, I don't know, maybe June, but probably July. But, it's such a minimal rate increase that it'll take at least till the end of 2018 for investors to actually get a return on their money. That's how far away we are from actual providing interest rates that make sense to bondholders. And the Fed funds rate itself has become fairly useless because now we're in a global world and we really need overnight rates that make sense to everyone. So from the viewpoint of the Fed, they need to get off zero interest rate. They must, so that they can reduce interest rates when they have to ease again. They don't have a way to ease anymore. From the viewpoint of the IMF and the rest of the world, they do not want to see the Fed raise rates.
Yeah, that's what I was going to come back to. Like, to what extent is the Federal Reserve sitting there going, if we raise rates, for example, as a Canadian, if they raise rates, I think it's a pretty good bet that you'll see the Canadian dollar go down, as an example. If you raise rates, that attracts capital from all over the world. It's like one bank having better rates than another. You sort of suck capital out of other parts of the world, which, of course, really limits their economic recovery. And so I can see why there's concern internationally about the Fed's potential there. How significant is it? How much does that factor into the Federal Reserve's decision whether to raise rates or not?
Well, that's a great question. It used to be that they worried about the U.S. economy only. And in essence, that's what Janet Yellen is saying now. Well, we're growing here. We're not really growing in the States all that much, 2.5%. Maybe we grow at 3%. But maybe it's enough to get them off zero. But having said that, it's interesting to note that they're all headed over to China on June the 7th, if I remember correctly, because the Chinese really want to know if there is going to be a rate increase, what do they have to do with their economy? In other words, will they see a capital outflow with increased rates in the U.S.? And so, it does impact the rest of the world very directly now. So it's not just a U.S. economic decision anymore as far as the Fed is concerned.
Well, we'd have a great example. This unprecedented sort of implementation of negative interest rates. It's not, you don't need a PhD in finance to understand that, hey, if I keep my money in this country, I actually it's a negative interest rate scenario. I actually have to pay them to hold it at the bank or a government bond. And here's the U.S., which is probably a safer currency, or at least equal to it, and they'll pay me. It's, as I say, it doesn't take a genius to figure out money's going to flow into the States.
Correct. And again, we've actually in the U.S. have been on zero longer than anybody. They went to 0%, essentially to 0% interest rates in 2009. So the Fed doesn't have any tools left, and if we have, and we will have another recession at some point in time, they don't have a way to ease any further. My view is that there will be a helicopter drop at some point here. The rest of the world is trying to choke consumers into consuming. And so that's what negative rates are all about. And I don't know that we'll see that because they worked in Sweden, they probably work in Switzerland, but I don't think in general negative rates really work very well, especially when one country that has the reserve currency status, like the U.S., has essentially decided they will increase rates no matter what. So it's an interesting situation. I think you'll see a helicopter drop. I think you'll see forced inflation. in the U.S., and that's why I think gold and silver are going to be interesting over the next couple of years.
I talked earlier in the show that my observation is for two reasons. One is that, like, there's a G7 meeting right now in Japan. They don't have a clue what to do. They've been doing this for 7-8 years, whether it's $7 trillion, in new money, or it's the zero interest rates, it's the quantitative easing, and none of it's worked. They don't know what to do. I also made the point that one of the problems is their starting point is, I don't know what to do given my priority is to protect the status quo. I mean, they're not prepared in Europe, for example, to do a radical reexamination of their labor laws, which are so, provide such a huge disincentive for hiring, as just one example. So the central bank stepped in. They're filling that void. But I don't know, but I don't get the impression they have any idea how they're going to get out of this unprecedented policy action.
Well, I think the real issue is that they're not. Central bankers really don't have the tools left to make growth happen, and so it's gonna have to take a fiscal kind of policy. It's gonna have to take, in the U.S., the Congress. It's gonna have to be something where it's coordinated action. And one of the interesting things that did come out of the G7 meeting was a lot of talk, but the talk was, hey guys, we got to work together. But then when you see the U.S. raising rates and everybody else the negative rates, well, that's not working together. That's working. So everybody's concerned about capital outflows. I mean, that's a big concern the Chinese especially have, and I'm sure that could be in the Canadian sense. The Canadian dollar will fall relative when this does happen. Having said that, again, they're going to have to do something. I'm so disappointed in listening to both the Democrats and the Republicans in the current debating that's going on, for the presidential. Nobody's talking about this issue. They're talking about all kinds of other things, but they're not talking about how do we get growth going and how do we work with the emerging world and with the Chinese, and how do we work with Europe to make sure that we are all on the same boat and we're all headed in the right direction. That's not happening.
No, I was just going to say, and I don't see it. I was looking at some data by a professor at Columbia University. I think it's James Henry it was. He looked at the last 18 months, and just to give people an idea, in the last 18 months, he estimated that $1.3 trillion in Russian assets were moved abroad. In China, it was $1.2 trillion. In Vancouver, for example, there's a ton of debate about upper-end real estate exploding, and some of it is at least due to Chinese money coming in here. It's happening all over the world, and that's why I'm trying to impress upon people. This is the key component. It's how money moves. I mean, you got a store, and all of a sudden a lot of people and a lot of money come in, you're going to do pretty well. You're trying to keep your store afloat, and all the money's leaving. You're not doing very well. Well, this is what's happening globally, and the numbers are staggering, though.
The numbers are staggering, and what is really interesting is we've seen several very prominent hedge fund managers and money managers, a.k.a. George Soros, putting several $100 million into the gold market. So, some of the smart investment money now is moving to gold and silver, and to me, that's new and it's different, and it sends a signal that I think we can expect much higher gold and silver prices, even when they raise rates and the dollar strengthens. We're seeing gold back down now to $1,220 or wherever it is, from almost $1,300. But it's going to be much, much higher as we go forward. And you're seeing the smart money moving into. I think Soros bought a couple $100 million worth of Barrick, for example, and there have been others that have followed suit on this. So it's quite interesting.
Well, one of the things that, of course, I think that gold has not performed, that a lot of people who are keen on gold just failed to understand, was that the U.S. dollar was more popular than gold. As when they recognized geopolitical uncertainty or financial uncertainty, well, the money was moving to the U.S. dollar clearly, and not moving to as much to other assets, and gold was one of them. But I think you're absolutely right, Mike. What's interesting is when you start seeing gold and the U.S. dollar rise in tandem, against virtually every currency, then that's a bull market.
Yeah, that really is a different thing, and we've seen that this year. Gold has come off a little bit in the last few weeks, but it's still significantly higher than it was. And we just saw some of the Japanese manufacturers start to move into silver, start to tie down Canadian silver companies. So it's interesting to see how silver will react and how gold will react here. And I think that we're gonna see some really interesting times in those two markets in the next 12 to 18 months. It's going to happen.
Yeah, it's going to be fascinating. I got to take a break. I'm talking to Dr. Michael Berry. It's always so fascinating because he gets, the opportunity and to talk to members of the Federal Reserve. I'll talk more about that because, of course, that's sort of the center of the universe right now. Everybody watch what central banks does, starting with the Federal Reserve. What's going to happen to interest rates, impacts currencies, impacts stocks, impacts your life right across the board. Dr. Michael Berry is co-editor of Disruptive Discoveries Journal. More with him in just a couple of minutes. Plus, I've got my favorite story of the week coming up and a shocking stat, the most amazing trading stat you're going to hear. I promise you, all of that coming your way on the Money Talks Network. One of the themes on Money Talks that we've been talking about for several years is the debt crisis. And it's not just at the sovereign level, which we saw manifest in 2010 starting in Greece. That was pretty obvious. Seeing it right now in places like Venezuela. You can see it in Brazil, China. The list is really a big one on that. But, of course, the decline in oil prices has changed the world, not just in Canada, but it's put a real strain on the banking system. Dr. Michael Berry is with me, Discovery Journal, Disruptive Discovery Journal. Dr. Berry, I wanted to come and talk a little bit about the uncertainty, at least I feel, about the banking system when it's got this exposure to oil and oil loans and the problems I've seen in the European banking system, for example. Maybe you could put a perspective on that for me, because that's the kind of thing that keeps me up at night.
Yeah, I think that the Saudis, as we all know, in November of 2014, actually American Thanksgiving, I believe it was, weekend, decided to pump oil, and so the price fell dramatically, and this caused ripples across the entire world. What we really worried about at the time and have worried about since is the whole issue of deflation, and deflation hits banks with a tremendous wallop. So, I think oil maybe bottomed at $26 US, if I remember correctly. It was around that area. Fortunately, it's gone back up to about $50, but we are seeing all kinds. I'm going to talk first about the U.S. banking system. We're seeing in the oil sector, we're seeing huge exposures, huge drawdowns. Wells Fargo's got a huge oil portfolio that's underwater now. Do I think that they're going to go under? No, I don't think so, but I think it's going to dramatically impact how they are able to, continue to be a commercial and an investment banking entity in the U.S. And there are a number of other banks like that. They have virtually no reserves to handle the oil exposure that they have. So in the Eagle Ford Shale in Texas, for example, and in North Dakota, no matter what Donald Trump says or said this week in North Dakota, there's a lot of bankruptcies occurring, and so this is curtailing production. It's putting people out of jobs. And it's putting certainly the smaller bank system at risk. In Europe, it's similar. There's the same type of exposure, but there are other things going on. Deutsche Bank, for example, has huge derivative exposure, and nobody really knows exactly how much exposure they have or how they're going to unwind some of their derivative contracts. And there's just a number of other issues that are happening there as well in Europe that I think have put some serious risk in the banking system.
We've only got a couple minutes left. What does an individual investor do? I still think that protection is at top of the list. Yeah, because of the risk you're just alluding to. Yeah.
Yeah, I think you diversify. We've had this tremendous run in the Dow Jones, for example, to 18,000, now it's 17,600. This market is, I don't care what anybody says, it's a bubble. So I think you diversify. I think that's what we're seeing some of the hedge fund managers do. We've had 5 years of a down market in the commodity sector. It's been due to deflation. I think we're at the bottom in that sector now. So I think a prudent thing to do is to diversify. And some of the Canadian silver companies now are really interesting. So some of the gold companies, as Mr. Soros has indicated, are interesting also. So I think you diversify, and I think you want to have some exposure to this sector, this natural resource sector at this point in time.
Last question. Do you still think the U.S. dollar will act as a magnet? Gold notwithstanding, too, attracting capital, as you've just alluded to. Will the U.S. dollar still sort of be king of the currencies?
Well, it certainly will if and when they, bump rates. Yes, it will.
Yeah.
I do think longer term that there's going to be a replacement for the U.S. dollar, but I think that's down the road 3 or 4 years, 5 years from now.
I hope we get a chance to talk about. Sorry, go ahead.
Yeah. Well, when we have an IMF banking system that actually will replace the dollar, the U.S. dollar as the reserve currency of the world. Yes.
Well, I was going to say, I hope we have a chance to talk many more times. Dr. Michael Berry is with Disruptive Discoveries Journal, but where you find it is www.discoveryinvesting.com, discoveryinvesting.com. Dr. Berry, thank you so much for taking the time. I love it every time.
My pleasure, Mike. We'll talk to you again.